it's a Trump win, how would you deploy your resources?
Actually, it depends a lot. The impact, firstly, will be more on markets outside the U.S. than in the U.S. Because if you have a Trump win, it is probably going to mean a stronger dollar, higher rates than you would otherwise have in a Harris administration. The tariffs are going to create uncertainty, which is never good for investment. And actually, I think it'll be negative not just for emerging markets, but across the world, across the U.S., and will impact global growth. Now, ultimately, the U.S. is not going to be immune to that because 25% of the S&P 500's revenues come from outside the U.S. So actually, I know the conventional wisdom is and consensus is that right now a Trump presidency is better for markets. And I think the immediate reaction probably will suggest that because of lower taxes, deregulation. But as you look out to 2025, picture is not that clear. Now, for us, what it means is that, outside the U.S., focus more on companies that are more focused on their domestic markets, less influenced by, global trade policies. In the U.S. itself, there's still some secular trends, and things like AI are not going to sort of change under any presidency. And so, things like data centers, for example, is an area where there will continue to be a lot of investment. We continue to see opportunities there. And like that, there will be secular opportunities elsewhere. And there are things like the IRA which could be impacted, but then, we don't make an investment on the assumption of IRA benefits. That may give a boost to returns, but that can't be the basis for our investment. So, steady as we go, I think we'll continue investing in the U.S.
But how does that differ then if Harris were to come to power? I mean, some say that perhaps if she's in power, we'll see lower rates.
So that will be more beneficial for emerging markets. So in a Harris presidency, we will be more constructive on emerging markets, particularly because, as you said, lower rates, weaker dollar, and less trade tensions that would destabilize confidence. And actually, emerging markets is interesting because they've done nothing much in the last decade. But that's partly been because whether you take the last 5 years or 10 years, earnings growth in emerging markets as a whole has been close to zero. That has inflected this year. We are projecting mid-teens returns in EM this year, and you're projecting double-digit growth in earnings in the next 2 years. Now, with that trajectory, actually, it could again be a good environment for emerging markets, which would suggest allocating more there. But if you have a Trump presidency, that creates new issues which we'll have to navigate through.
The thing is, right now, there seems to be a lot of complacency in the market. What's the market underpricing at this stage?
A lot of tail risks. I mean, today we have wars, we have economic fragmentation, we have political polarization, we have social unrest, and in all that, the S&P is trading at 22 times forward earnings and assuming on the basis of a 14% earnings growth in 2024. And this is on the basis of margin expansion of what are the peak margins ever in U.S. history this year. So you're really priced to perfection. I mean, the last time the U.S. traded at 22 times earnings were when real interest rates were minus 1%. Today, they're close to plus 2%. So you really got to believe, and maybe the belief is that, AI is going to be this huge productivity boom, which will continue to let margins expand, and everything's just going to be perfect. So in that sense, I think there is a risk to the markets, and I'm sure there will be 2025 will probably be more choppy than we've seen in the last couple of years.